Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by Riveles Wahab legal firm. Now, I'm very pleased to have Simon Riveles with us today to discuss launching an incubator hedge fund. But before I do pass the controls over to Simon, I'd like to introduce my colleague, Emmett Peppers. Emmett is with Interactive Brokers Sales, and contact information is included on today's session. Emmett,
thanks, Cynthia.
I'll pass this to you. If you would introduce Simon, we'll get underway. Thanks for joining us, Emmett.
Sure. Thanks, Cynthia. Yeah, hi, my name is Emmett Peppers. I've worked in sales, Interactive Brokers for a while, but I've known Simon for over 10 years now in my current sales role, and I've seen him work with many of our startup hedge fund clients over the years and gotten to know him very well. Simon has been practicing securities and corporate law for close to 20 years and started his firm in 2012. And his firm is Riveles Wahab, and it's based in New York City and focused on fund formation and investment management law. So I'm excited to have this webinar with him, and it's the first one he's done with us, and I think there's been a lot of interest and excitement. Many people are registering. So with that, I'll pass it on to Simon to let him get started.
Great. Thank you, Emmett and Cynthia, and thanks everyone for joining. Good to see that we have a healthy group who's interested in this topic. Yeah, and thank you, IB, for organizing. You know, the presentation is actually quite brief. It shouldn't take us more than about 15 minutes to get a good handle on what's involved in setting up an incubator hedge fund. So by all means, please, you know, type out those questions if any come up, and we'll certainly should have time to address them after the presentation. As Emmett mentioned, I'm an attorney here in New York with a boutique hedge fund, private fund, investment management law focused law firm, Riveles Wahab, LLP. So with that said, I'll just dive right into the material and look forward to addressing any questions you have at the end of the presentation. So
Simon, it looks like your phone was muted. Could you unmute your phone?
Yeah, sorry about that all. Technical hiccups already, but hopefully I'm back online.
Yes, we can hear you now. Thanks. Simon, let me unmute you.
Okay.
Oh, there you go. Oh, now we're ready. Go ahead.
Are we on? Okay, I'll try not to hit the wrong button here. What I'm trying to do is move my slide through. Okay, so I think we're cooking with gas now. So the establishment of an incubator hedge fund involves the organization of a typical GP-LP fund structure that is characteristic of a full hedge fund. But what it doesn't involve is the preparation of the legal documents needed to accept outside investors, such as preparation of a private placement memorandum or subscription documents. Establishing an incubator fund can be thought of as laying the foundations for a house prior to constructing the entire home. An incubator fund provides startup managers with a cost-effective method to generate a marketable track record by trading or investing the manager's personal capital before incurring the considerable expense of launching a full-fledged hedge fund open to outside investors. Rather than hoping to generate interest from outside investors before the fund entity has a track record of trading and investment returns, an incubator fund manager will generally trade their strategy for a period of 3 to 6 months. Although there's of course no limit to the amount of time a fund can remain in the incubator phase. And I have a variety of managers that may generate a track record over 2 or 3 years and only then decide to take on outside investors. As the viability of the fund strategy is proven during the incubator phase, the marketability of the fund and the manager's credibility are greatly enhanced. Building a track record with personal capital in the fund entity also helps to avoid many of the pitfalls of marketing with a track record generated at a former fund as an advisor to separately managed accounts or through trading in a personal account. Past trading returns obtained through former funds, advisory firms, or personal accounts, even when the fund to be launched is pursuing a substantially identical strategy, must be carefully disclosed, if at all. If not done properly, presentation of prior performance can easily be deemed misleading and is susceptible to accusations of cherry picking. Another potential advantage of launching an incubator fund first is that the incubator period provides the manager with additional time to sit for exams if needed, further develop marketing materials, build out the fund's back-end operational systems, and otherwise further refine the fund terms and structure. Let me skip here to the next slide without muting myself. Okay, how is an incubator fund structured? So the structure of a fund is typically no different whether it's first launched as an incubator and later converted to a full-fledged hedge fund, or as a full-fledged hedge fund right off the bat with outside investors being accepted at launch. A fund is typically established, as I mentioned earlier, under a GP-LP structure with a limited liability company domiciled in the state where the manager's primary operations are located. The LLC serves as the general partner to the fund, which is organized as a limited partnership in the state of Delaware. Delaware is most often favored as the domicile of the fund as a consequence of its well-developed legal jurisprudence, sophisticated courts, and the commonly held view that Delaware law does not favor the interests of investors over fund managers, whereas some other states have a reputation for or the perception of being favorable to investors. On occasion, there may also be tax advantages to establishing two management companies. In the case when the manager is doing business in a jurisdiction such as New York City or Texas, which each impose a city or franchise tax on the performance fee that the manager charges to the fund, if the management fee and the performance fee are commingled in one entity, these taxes can be applied to the performance fee. By setting up a separate management company from the general partner entity, the manager avoids having either the franchise tax fee or the city UBT tax in the case of New York City from being applied to the performance fee. Another question that often comes up in the context of incubator funds is, can family and friends invest in an incubator fund? And the answer simply is really no. The federal securities and state securities law requires that all outside investors, whether friends and family or institutional investors, receive full and fair disclosure regarding all material terms of and risks involved in the purchase of an interest in a pooled investment vehicle, namely the purchase of securities, which when an investor subscribes to a fund, they're purchasing securities. These comprehensive disclosures are generally provided in the fund's private placement memorandum. Once a manager is ready to take on outside capital, the transition to a full-fledged hedge fund is quite straightforward, generally. Primarily, it involves the preparation of the fund's PPM and subscription documents, generally by a fund attorney such as myself, which is a process that can take about 2 weeks. Typically, a PPM is between 40 to 60 pages, and it is meant to outline all material aspects of an investment in a fund, including the fund's economic terms, risks, the tax aspects, and other pertinent considerations of investing in a fund. Taken in sum, the disclosures in a PPM are meant to provide prospective investors full transparency as to all material considerations surrounding an investment in the fund. After the PPM and subscription documents are provided to investors and returned by investors to the manager, all securities laws have then generally been complied with, and a manager can accept outside capital. Another question that often arises is, does the manager need to be licensed or engage a fund administrator during the incubator phase? Since a manager is only trading personal capital during the incubator phase, the investment advisory laws of the state in which the manager is located generally do not apply, and the manager will therefore not need to have passed any industry exams or be registered as an exempt reporting advisor or investment advisor with state securities regulatory authorities, or with the SEC for that matter, even if the fund has a large AUM. Also, when there's no outside capital in the fund, most of the work of a fund administrator, such as valuing the fund's assets to allow for subscriptions and redemptions, calculating the fees and expenses attributable to each investor's capital account, and preparing periodic reports for investors is of course not necessary. So one of the primary ongoing expenses of running a full-fledged fund can be avoided. Next, are there negative tax consequences to a manager trading personal capital in an incubator fund? Generally, no. So since a U.S. fund is generally organized as a limited partnership or less frequently an LLC, the fund is considered a pass-through entity for tax purposes. As a consequence, all gains and losses pass through the fund entity and are reported on the investor's personal income tax return and on Form 1040 and Schedule K1. The manager therefore faces identical tax obligations and not identical reporting obligations, but for the most part, similar reporting obligations, whether the capital is invested in a personal account or in the incubator fund. Next, is there a minimum capital contribution needed to seed an incubator? And the answer is, legally speaking, no. Any amount of capital legally will suffice. Practically speaking, of course, a manager is advised to fund the incubator with sufficient capital to adequately implement the strategy they intend to pursue. If the strategy or the incubator fund is underfunded, returns in the incubator may not be representative of the returns likely to be achieved in the full fund, and that, of course, can be problematic for presentation of return purposes. Obviously, there's no way to, there's no particular amount of capital that is always a minimum that can be specified that's needed to vet a strategy. So it certainly is fact dependent on every manager's particular strategy, the instruments they're trading, and the types of diversification that their portfolio may contain. For moving on, when would launching an incubator fund as an offshore entity make sense? I get this question quite a bit, and the way I generally answer it is that if the manager anticipates that the fund will be initially composed primarily of non-US investors or tax-exempt US investors rather than taxable US investors, an offshore fund incorporated in the Cayman Islands, for example, may be the right choice for that manager. An offshore fund allows non-US investors to avoid the need to obtain a US tax ID and report annually to the IRS, and ensures that tax-exempt investors avoid any unrelated business taxable income, otherwise known as UBTI, which is associated with investments by tax-exempt US investors in a US fund that borrows capital or is levered. So getting into some of the nitty-gritty in terms of the cost of setting up an incubator fund, generally, and I will move the slide as well. Generally, an incubator fund can be established for approximately $4,000, including state entity formation fees for the general partner and the fund entity itself. This initial payment. Hello? I just heard some background music, but I'll just move on, Cynthia.
We can hear you, Simon.
Okay, great. Thanks. Yeah, as I mentioned, an incubator fund generally can be established for about $4,000, which includes the state entity formation fees for the limited partnership, the fund, and the management company. This initial payment will be applied to the overall cost of launching the full fund when the manager determines to accept outside capital, such that the total cost of the full fund is the same whether an incubator fund is first launched or not. Additionally, since an incubator fund does not require an outside administrator or an auditor, unless of course the manager wants his or her track record to be verified or audited by an independent third party, the ongoing operational costs associated with running a full-fledged hedge fund with outside investors is avoided. As such, other than the initial legal cost to establish an incubator and any year-end tax preparation expenses, the ongoing cost to operate an incubator is fairly minimal, which of course is one of the benefits of establishing an incubator first. So to summarize, some of the services we provide to managers looking to launch an incubator fund is reviewing our fund formation questionnaire, which is a process we go through with a manager whether they launch an incubator or a full fund, and that document is meant to suss out the economic terms that the manager intends to structure the fund under, any liquidity provisions such as withdrawal provisions, lockups, notice provision, whether hurdle rates will be imposed, investor qualification requirements, and a variety of other fund structuring variables that we take about an hour to 2 hours to go through in depth with the manager, whether an incubator fund or a hedge fund. Also, we advise the manager regarding the registration requirements that are particular to the manager based on their location within the U.S., depending on the state, and of course, if outside the U.S., a variety of other considerations may be applicable. Certainly, the registration and regulation obligations, while not generally present, as mentioned previously, for incubator fund managers, it is something to be considered, obviously with a view to launching a full fund in the future, and will be dependent on what sort of instruments the fund trades, whether securities, futures, forex, under certain circumstances, cryptocurrency, although of course not currently supported by Interactive. But so we will review those variables with the manager and advise them. We'll also review marketing materials that the manager has prepared or does, prepare in the future for legal disclosures, and also just as a courtesy and a review of those documents. Lastly, we'll also, of course, make any needed introductions to administrators and auditors, and of course, to Interactive, assuming the manager is going to be using Interactive, which in my experience is generally the case for the vast majority of managers that we work with, and that's why Emmett and I have been working closely together for so long. In any case, that is really the substance of the presentation. I think it gave a fairly comprehensive overview of incubator hedge funds, and I see that we have one or two questions, which
Simon, if I could jump in, I'd like to remind everyone, if you do have a question, now's the time to pose it. We have both Simon and Emmett are available to answer your questions. Remember, there's the questions panel that's included on the right-hand side of your screen. Simply double-click that title bar. You can actually even expand that panel and send us any questions that you might have at this point. Okay, back to you, Simon.
Thanks, Cynthia. Yeah, I see that a few more questions came after you mentioned that. So it looks like the first question is from Ravi, who asks, how much does it cost to take to register an incubator fund? Can we register a master feeder? What's the most effective structure for registering an incubator fund from a tax perspective? Ravi, so as I alluded to in my presentation, I generally recommend a U.S. fund, or specifically a Delaware limited partnership, is established when the fund anticipates the initial investors to be primarily composed of taxable U.S. investors, and under certain circumstances, tax-exempt U.S. investors, although there are limitations as to the amount of tax-exempt capital, particularly defined benefit capital a fund can accept. And certainly there are limitations if the domestic fund is borrowing capital from a broker. But for the most part, a domestic fund would be the right entity to, if it's anticipated that taxable U.S. investors will be the initial investors, whereas an offshore fund, often incorporated in the Cayman Islands, is probably the right approach if non-U.S. investors are anticipated to compose most of the investors in a fund. There's, in my view, no reason to set up a full master feeder fund structure just for the incubator. It does increase the cost of the launch significantly, and since no outside investors are being accepted, there's no need for feeders, whether in the US or offshore. There's just a need for the ultimate master fund, the trading vehicle, to be established. So to be most cost efficient, typically one entity, whether onshore or offshore, is used for the incubator, and then certainly that can be converted into either a mini master feeder or a master feeder fund structure. And certainly, if Ravi, for example, if you have additional questions in this regard, my contact information is on the slide, and feel free to reach out, and we can schedule a free consultation to discuss the nuances some more. Elaine asks you, Simon, you mentioned there's no time limit to keep the fund as an incubator fund. What are the costs of the incubator fund? And what happens if the incubator fund does not work out and needs to be closed? So that's absolutely right, Elaine. There certainly an incubator fund can be run as long as the manager likes, and under certain circumstances, I have managers who never convert to a full fund with outside investors, but they have the optionality inherent in an incubator fund, even if they've been running it without outside capital for 3 or 4 years. And the longer a solid track record is developed, usually the more compelling it can be. So I've seen scenarios where a manager runs an incubator fund for 3 to 4 years and only then takes on outside capital.
Simon, this is Emmett here real quick. Let me just tag on to that, what you were mentioning about the no cost. One of the great things about Interactive Brokers and our prime brokerage offering for hedge funds or incubator funds is that we don't have any minimum AUM requirements or minimum fees. Virtually every other prime broker is going to want a certain amount of money per year generated in fees to keep that business going. So there, with other prime brokers, there are ongoing costs to keep that prime broker happy, obviously. But with Interactive Brokers, one of the reasons Simon mentioned he sees so many incubators use us, for example, is because we don't have any cost requirements that we want you to generate as an incubator fund. Sorry about that, Simon. Go on.
No, that's a great point, Emmett. Yeah, in that respect, it's having an incubator fund. There's limited risk. And to Elaine's question, if the incubator is never converted to a full-fledged fund, the legal cost involved in setting up the incubator, as I mentioned, is a one-time flat fee of about $4,000. And maintaining the entities is about $300 or $400 for a limited partnership in Delaware. So that's a yearly ongoing cost. Typically, there's no maintenance cost to maintaining the management company, and then there's any tax filings that have to be conducted, which some managers may take upon themselves, in which case, of course, there's no fee, and some managers outsource that to an accountant. So the ongoing costs are fairly minimal, and obviously, as Emmett mentioned, Interactive doesn't impose any additional fees that they wouldn't otherwise. So it's fairly cost effective. So Trey asks, how much is the cost of converting an incubator to a full-fledged fund? Ballpark, it's another 10,000 approximately to convert, and making the total cost between about $13,000 and $15,000, depending on for an onshore fund, depending on there are some variables there, but generally it can be done for that amount. And as I mentioned, the cost of the incubator is applied to the full fund cost. So the 13 to 15,000 is the total fee. A manager is generally looking at from a legal perspective, whether it's initially structured as an incubator or a full fund, as mentioned.
The next, Simon, if you're done, I'll read the next question.
Yeah,
I think it's
absolutely.
okay. Yeah, the next question from Ravi says, does Interactive Brokers provide any seed capital for startup hedge fund managers? We do not provide seed capital for startup hedge fund managers. Interactive Brokers does not. But we do have a hedge fund capital introduction program that you're not eligible for, while you're an incubator fund, but the track record you build as an incubator fund does count towards being applied for our capital introduction program. So there's more information about that online, and I can certainly, email you, or you can email me asking questions about our capital introduction program for hedge fund managers. And I'm happy to share that with you if you're interested.
Thanks, Emmett. The next question is from Jeff. Do I have to begin an incubator with my personal funds, or can it be the funds of an LLC that I own? It's a good question, Jeff. Whether the incubator is seeded with personal capital or from an LLC that you're the sole owner of and controlling authority of, should not matter. So it would be problematic if there were other investors in the LLC and you controlled the LLC and then seeded an incubator with that. But certainly if you are in control of and own the LLC, that can be used to seed the incubator, and you could even depending on facts and circumstances, use that LLC to serve as the general partner to the fund. But we would want to delve into the specifics of your situation in a little more detail. So another question from Jeff: if I begin with a partner or partners, can we all use our funds collectively? If you do have one or a few partners and everyone has managerial authority over the management company and voting authority with respect to all aspects of the management company, then that can be accommodated within an incubator structure, although potentially somewhat more complex depending on the relationship between the partners and any specifics regarding structuring of the management company. But in general, certainly, yes, that can be accommodated. Trey asks a question regarding the licenses for a fund manager. It very much depends on the state that a manager is based in. Generally with funds of less than 25 million of assets under management, there is no licensing required even when the fund has outside capital. In other words, it's a state-by-state analysis that we would have to look at as to whether you need to be licensed. Generally, it can be avoided, certainly until the fund has 150 million of assets under management, when in all cases the manager and the management company has to register as an investment advisor with the SEC and generally take the Series 65. But in most states, before that AUM threshold is reached, licensing per se can be avoided. Another question from Christoph. The annual costs of having a track record audited or verified, what are those? Certainly, Christoph, you'd want to speak to an administrator, an outside third-party accountant. Essentially, they're referred to as administrators in the fund industry, and they can give you a more exact quote. But in my experience, it can be as little as a couple $1,000s a year to have the returns verified, but it very much depends on the specifics of your strategy, and certainly the administrator you use. To have an audit firm or certified public accountants audit a track record is a similar process, but it comes with somewhat more credibility, although more or less the same, and that can be a little somewhat more. If you want to get in touch with me, Christoph, I can refer you to a few administrators and auditors in the space who can be of assistance, or at least get more granular with you in terms of the costs involved.
Yeah, this is Emmett again. Yeah, Christoph, like Simon mentioned, you're welcome to contact us to get you in touch with other accountants or accounting firms that have used Simon services or Interactive Broker services, and have been happy with those accountants or accounting firms for that purpose. Joe asks a question: will cryptocurrency come to the IB platform, and if so, when? We don't offer cryptocurrencies right now. I can't speak for the future, but I don't believe there's any plans for it. We do offer exchange-traded products, and we do offer exchange-traded futures contracts on Bitcoin, for example. That's a way to get exposure to aspects of that asset class with an Interactive Brokers account. That's all I could probably say about that at this time. So, and the next question from Jeff is: would the auditing need to be done yearly, or can we have it done before we convert to the full fund? And Simon, correct me if I'm wrong, but I don't think they are required to have any auditing done for an incubator fund, and that maybe only if they feel like their track record is good enough where they want to convert to a full fund, then it makes sense to them to get the audited financials. Is that what you think too?
Yes. Yeah, absolutely. I think, certainly to have a track record verified or audited at the end of every year will put the manager in a stronger marketing position, in that, while in the incubator phase, they'll have the ability to show verified or audited returns rather than so as to build interest during the incubator phase. But certainly waiting till the manager is actively marketing to outside investors or ready to convert to the full fund and take on outside investors, that's a way to approach it too. I don't honestly know whether there would be much in the way of cost savings if it's done right before launch of the full fund or yearly, but it either way is certainly doable.
Yeah, sometimes incubator fund clients of mine will ask, how do I know if my returns are adequate enough to compete with other hedge funds where it's worth my additional cost to turn it into the full-fledged hedge fund at this point? And what I typically will say to those clients is they can actually look, speaking of our hedge fund cap intro program earlier, they can actually, from their Interactive Brokers account, click on a few clicks in it to view the cap intro program from an investor perspective. So they can see the list of other hedge funds on our program and their performances and marketing materials to kind of get a feel for where they might fit in terms of performance versus, the competitors on our cap intro program, for example. So it's just an extra tidbit of info some people might be interested in.
Yeah, that's really helpful, Emmett. Yeah, and in that way, in my experience too, the IB platform allows a manager to get a sense of where their returns, how their returns stack up against other managers with similar strategies, and that the incubator fund again gives the manager time to see how the strategy is working out and how much potential success they may have marketing marketing to outside investors.
Yep. So I guess Jeff asked another question: is there an auditing component on IB? I'm not entirely sure what that's asking. We do offer, statements and reports, and typically the auditors or the accounting firms will go through that as part of their audit of the account at that's been primed with Interactive Brokers, or the incubator fund that's been primed with Interactive Brokers. But certainly, we've talked a lot about the auditing. You can email myself or Simon for more questions, and we can get you in touch with the specialists on that topic, I'm sure.
Yep. One last thing, Jeff, on that in that regard, the audit is really what an auditor will do is take the comprehensive return reports that IB system can generate, and will verify them independently. And that's what investors are looking for, is an independent third party to verify those returns. So just to clarify that.
Yeah, thanks, Simon.
So it looks, Emmett, like we've addressed at least all the current outstanding questions.
Yeah, I think so. One other common question that I see that comes up a lot is, if someone has an individual account with Interactive Brokers already, or maybe it's somewhere else even, but they want to, then they work with you or someone like you, for example, Simon, to set up a legal structure for an incubator fund. How do they move? What's the best way to move the assets from a personal account into the incubator fund structure? And, it depends on a lot of things. It's a very good question. It's probably best to email me. We have a few different options to offer there potentially. So, if that's something you're asking, we do have answers for it, but it's probably more in depth than can be answered here. And another question I sometimes get is, registered investment advisors, independent registered investment advisors, are often curious about setting up an incubator fund. And oftentimes, I believe for the legal formation structure, the LLC entity will be the RIA entity itself. Is that what you see too, Simon? Or sometimes it's not, but sometimes it is. What are your thoughts on that?
Yes. Often, if there's a registered investment advisor, that will serve as the management company to the fund with a separate general partner entity. Often it's structured that way, although it can certainly be structured with the registered investment advisor being the general partner without a separate management company. In my view, there's not much difference. between the two structures, although, as I mentioned, in certain tax jurisdictions, there is a benefit to having a separate management company. But, that would be one aspect that I would work through with the manager to make sure that they understood all of the nuances of either approach.
Okay. And one last question that came in from Rodrigo. It says, advantages of running a hedge fund against advisors structure. So I'm assuming, the advantages or disadvantages of running a pooled hedge fund versus separately managed accounts. And in my experience from a brokerage sales perspective, there's pros and cons. It's probably a more in-depth answer than can be said on here. But quickly off the top of my head, I would say, with the hedge fund pooled investment vehicle, the investors in that do not have to open accounts with Interactive Brokers. They don't each have to open an account with Interactive Brokers. If you're doing the advisor managed account structure, then each of your clients, they're not really termed investors now, they're termed clients. Each of them open up an account for themselves with Interactive Brokers and give you as the advisor trading discretion over their accounts that are technically with Interactive Brokers. So that's sort of in a nutshell, but we can branch off from there, many different pros and cons of other things in terms of marketing or whatnot, but best to probably email or get in touch offline about that. I don't know if you have anything to say about that, Simon, too. You want to plug in there or not?
No, I would agree with that assessment, Emmett. I think, and obviously one pooled investment vehicle where a manager can advise and trade one pooled account is more scalable than having, tens of different separately managed accounts, if not more, under certain circumstances. And so I think it also from a marketing perspective, there may be nuances in the performance of different separately managed accounts, whereas it's more difficult to present a unified track record for the strategy because each investor, may tailor their strategy somewhat. So I think from a unified marketing standpoint, a fund is preferable, and from a scalability standpoint, as I mentioned, of course, a fund, investors are giving up custody of their assets. They're contributing their capital to a pooled investment vehicle, as Emmett mentioned, that's managed by the manager, which some investors are takes them a little while to get comfortable with, rather than having the account in their name, which they ultimately have immediate control over. So I would highlight those as the high level, the considerations. But again, happy to explore some pros and cons of each approach, Rodrigo. Yeah.
Yeah, and just one more note, Rodrigo, is that you can actually do both. You don't have to do either or. A lot of our clients that I see that even work with Simon, they have a hedge fund and they're looking to take on managed accounts now, or they have managed accounts business with an advisor and they're looking to set up a hedge fund too. So that, you can get the best of all worlds if you do both, for example. It's just, a little more work to manage or administer, but in terms of the pros and cons, you can get all the pros by having both potentially.
Absolutely.
Well, fantastic information. Thank you so much, Simon and Emmett, for that additional portion of our webinar. Now, before I do close today's webinar, I do want to point out that we've left the contact information on the screen. Notice in your viewer, you'll see an icon. If you do want to capture that, you can actually grab a screenshot before we do close down today's event so that you can come back and access or contact either Emmett or Simon with any of your additional questions. But it looks like that is going to conclude our session today. Thanks once again for Simon Riveles and Wahab, LLP, for today's presentation. I also want to thank my colleague Emmett for participating here with us today. And by the way, thanks to all of you for the time that you spent this afternoon. We are going to conclude today's session, but I do want to remind you, we have been recording today's event, and if you do want to come back and review any of the concepts that were discussed here today, simply watch your inbox later on this afternoon. I will be sending out a direct link to today's recording and to the slides that Simon's been using with us here this afternoon. So have a great rest of your day, everyone, and thanks so much. You can all exit using the X in the upper right-hand corner of your screen. Have a good one, all. Thank you.
Thank you.
Thanks, Cynthia.